Welcome to Subramani. Every year, and in India more than once a year, maybe once during the calendar New Year, once during the Samvat New Year, and once during Diwali, or more or less at least twice a year, if not again in April, we try to predict what the markets will do over the next 1 year. And most of the times we are wrong. When you see which fund house is talking about it, you know that they are going to be optimistic or pessimistic, or which individual. Some individuals are born optimistic and they are always optimistic even when they have gone wrong completely in the previous year. Last few years there have been reasons to be optimistic, so every year the market has been going up, so it is easy for us to be optimistic and say 25% growth and 18% growth or whatever number you want to give. And we know that is this ritual of going wrong, because most of us go wrong, right? When you say 25%, you may end up getting 22%, you may end up getting 37%, you may also end up getting -5%. All these things have happened in the past, so it's not that we are new to this. So, but do we stop the ritual of predicting what is going to happen? No. Why do we not stop? I think Jason's week says this ritual is not only wrong, but it could also be toxic. And it is not meant for you. It is meant as a conversation starter for the salesman. Imagine I am a salesman and I come to you and you ask me what returns will I get in equity, or typically kitna milega, right? So I have to give you a number which is attractive for you, which does not repulse you, which you are not being don't want to get hurt by that number, and you don't want it to be over ambitious, because social media and mainstream media and all have told people that if somebody comes and tells you this product will give you 25% return, you should not trust that person. That person is perhaps lying, right? He is a fly-by-night guy or whatever. So as a salesman, I cannot say 25%. It does not matter what is my view, what is my fund house view, whom I am representing. I can't give that number. So I have to give you a number which is approximately right and attractive enough for you to choose my product, which is an equity based product. Maybe it's a multi-asset fund, but it is a equity based product, and the number has to be better than the bank fixed deposit, which is perhaps today in 2025 January at something like 7%, right? So that's a number I have to give you. So it has to be an anchor. Now it is easy for me to use that as an anchor if more and more people have said that. So I can quote, I can say, look, Motilal Oswal says this, Kotak says this, HDFC says this, ICICI says this. So the consensus is you will get 16% return or 15% return in equity markets. This is good enough to impress, because so many big people can't be wrong, right? Well, everybody can be wrong because everybody anchors around a particular number, right? So you've just seen a number of 8% somewhere on television or somewhere, and they say inflation in India is going to be so much, growth rate is going to be so much. So you pick a number and say, oh, I think equities this year will return 13% or 14%. You may be right, you may be wrong, you may be as wrong as the analyst who gets a 2 crore salary, you may be as right as an analyst who gets a 20 lakh rupee salary, and all kinds of analysts do exist, right? So here is a number given to you with which you start so that the conversation goes on and you can do some sales. It is meant for the salesman, it is not meant for you. Typically when the budget is going to be announced, which will happen obviously in February, it is a media event. Media will ask everybody, what do you think is going to happen? Which sectors will be favored? Nobody knows, right? Even in the earlier budgets, people did not know, people were guessing, and using that, what is going to happen in the budget, to say what is going to happen in the economy, and therefore what is going to happen in the equity market returns in your portfolio, is a game which none of us can ever play, right? It just doesn't matter. Ultimately what matters is what are the long-term goals that you have, whether you are achieving them, and on the back of 2-3 good years, chances are equity will not do well, right? So if you require the money in say 2028 January, which means you are 2025 now, 25 to 26, 26 to 27, and 27 to 28. If you have these 3 years and if you need an X amount, and you have to withdraw, say, suppose you need 18 lakhs. My suggestion would be to take 50,000 out of the market every month, do an SWP and put it into something like an arbitrage fund. So you're participating in equity, you have equity taxation, and after 3 years you will again pay equity taxation when you remove that money. At least for a big portion you will pay equity taxation, right? To do something like that, and I'm not suggesting an ultra short bond fund simply because of the taxation. So when you put into something like an arbitrage fund, you're protecting your money. Chances are it will not go down over a 3-year period, and you would have withdrawn 18 lakhs for yourself, right? So somewhere if you see after 2.5 years that you have already reached 15 lakhs and you don't need more money, you can stop withdrawing, right? And you can allow the arbitrage fund to give you 5% or 6%, whatever, and use that money. Or you say, oh, market has gone up too fast, then you make a lump sum withdrawal, put it in an arbitrage fund and let the other remaining money grow, right? So all these possibilities are there. So this for you is an indicator as to how you should deal with your money, and not worry too much about what the so-called experts think or what the market will do over the next 1 year. So can they predict equity returns? Chances are nil. Can they predict bond returns? Well, bond returns also, I mean, I remember 1982, I think market went up some 40% in the US bond market, right? You never think such kind of things are possible. And I think in 2022, I think the market came down 5%. You lost 5% in bonds, which again, not very few of us, we know we run inflation risk, but do we expect to get a minus 5% return? Answer is yes, someday it had to happen, because that 40% had to be spread over 40 years. That had already happened, and now you had to get a negative return. That's easy to say in retrospect, but there was no reason for us to assume in 2021 that 2022 market will take such a big beating, because there will be inflation coming back, right? We didn't know any of these things. So can you predict gold prices? Can you predict Bitcoin prices? Can you predict bond prices? Can you predict equity prices? It's not possible at all, almost impossible. The only thing you can predict is perhaps savings bank account or a 1-year FD of State Bank of India will be around this much, but because the margin of error is less, you're not going to say, oh, you'll get 12% return in SBI FD. It's not going to happen. So if it is 7, you could predict anything between 6 and 8. Right, you will not predict some 16%, whereas you will make such predictions in case of equity and be completely right or completely wrong. And there's no logic as to why you were right or why you were wrong. But we do this ritual for various assets, and over coming next 1 year, kitna return milega? I mean, typical question which every investor asks, whether he's investing 1 rupee or 100 crores, right? So, and how inaccurate are these forecasts? I don't think too much analysis is done in India about which brokerage firm said what and what was achieved. In the US, there has been some research, and he says over the past 20 years, according to Joachim Clement, an investment strategist in London, the correlation between the forecast and the market's actual returns was minimal for the analysts and zero for the strategists. Right. So naturally, after 2 straight years of 25% return, 25% plus returns, the analysts and the strategists have made their 2025 forecasts up to 13.4% and 12.5% respectively. Remember, this is in the background that Goldman Sachs and all of them have now said something like single-digit returns in equities, what you should be expecting going forward, because a lot of our returns have already come upfront. But banks, brokerage commonly forecast the 1-year returns on everything, on bonds, gold, commodities, cryptocurrencies, real estate, everywhere they go and predict, and mostly they are wrong. Jason Zweig says, decades ago, psychologists Kahneman and Tversky asked people to estimate the percentage of countries in the United Nations that were in Africa. However, the participant watched the spin of a wheel of fortune numbered from 0 to 100. On an average, if the wheel stopped at number 10, people estimated that 25% of UN members were in Africa. But if the wheel landed on 65, the participants said something like 45% of the UN countries were in Africa. Right? So we call this anchoring. So all of us have this kind of mistakes in our head, and we also are likely to say what we want to hear, or rather what we think we should be need to get to meet our goals. So all these numbers somewhere, put some number in your head, or you have heard from a bank or a financial advisor or a financial influencer. They predict that many of them have predicted 10% jump into 0 to 5 in US stocks, and gold will gain 15%, and again Bitcoin, there is a varying number. Those numbers unconsciously are in your mind, so for you it becomes an anchor. You will anchor around that 10% which a Goldman Sachs says, or a JP Morgan says, right? So I don't know how useful it is to have these predictions, because I mean, the long term average does not really matter. What really matters is how much return do you need in your portfolio. Is it possible? Is it reasonable? Do you have to achieve all those goals? Is it fair to assume that because you need 25%, the market is going to give you 25%? The market is not. Do you need to take more risk to achieve your goals? Then your goals need downsizing. You cannot say market has to give me return because I have to meet my goals. That's not going to happen. So like I said, if you don't have any requirement of the money for the next 3, 5, 7, 10 years, or then your money can be lying in equity without really mattering. However, if you need the money in the next 3 years, I would suggest a SWP starting today. And if you need the money in the next 5 years, I would think do an SWP over 5 years, no. But yeah, whatever excess you have, start putting money in that in an arbitrage fund. Right, so keep accumulating money for that goal in the arbitrage fund. Don't put it in equities. And from the equities, if you think suddenly the market is spiked up or something like that, take some money and put it into that arbitrage fund, so that by the time it is 5 years, you have your money intact at reasonable rates of taxation. This is what you should do. So forecasts are not very useful. In fact, Jason Sevik says forecast can even be toxic, right? So, but understand one thing, forecasts are a point of conversation for the salesman talking to you, and not really for you to follow when you are evaluating your portfolio. Thank you.